Well, welcome back everybody to another Pepperstone live event here. My name's Thomas Atkinson. Today we're covering a little bit of a different topic, multi-timeframe analysis, how to do it like a pro, and with some live examples with the current market. As everybody knows, it's been a very volatile 2025, and that means that we've had to possibly sometimes change our opinions on where markets are going to move to next. And a lot of that can be helped by the techniques that we're using today. So hopefully you're going to learn something. As always, if you've got questions, ask them during the live recording here, or if you're watching on YouTube, make sure to check out the links in the comments down below and sign up for our live shows. As always, I'm joined by Tyron Abella. Tyron, how you going this week, man? It's been volatile. We've flipped back the switch again, and seems to be always about tariffs.
Always about tariffs. Welcome, everybody. Look, for those of you who join us every week, you notice probably we talk about multi-time frame analysis a lot. We always break it down from the top down to the bottom, but it's probably an underutilized resource. A lot of traders don't pay enough attention to, really, because when you actually do break it down properly from the top down to the level that you are going to trade it at, it's actually a really, really big advantage of knowing, what the market is actually doing. So I'm looking forward to delving into tonight some techniques that can help you actually use it and just be aware of it. I think being aware of it, sometimes, you'll see Tom put a weekly chart up or a monthly chart, and you say, why would we ever trade that? But it's not really about trading that chart. It's about understanding what the market's doing on those bigger time frames and then being able to work with it. So we're looking forward to it's a really important topic. So one that I'm sure you'll all enjoy and benefit from.
Well, let's start things off with everybody's favorite metal, which is obviously gold. And we are on the monthly chart where we always like to start. And this doesn't mean you could trade a 5-minute, but we're just coming down here through these timeframes. And I think it's pretty clear that if you were to check off what the trend has generally been, it's obviously bullish. So if you're talking about flows, just remember, where are the biggest trades and biggest investments made? And they're not made on the 5-minute charts. They're not made on the 15-minute charts. They're made over a series of periods of time, which are generally between, weeks into months, into possibly even years. And this is because often we get central bank policy that pushes these markets around for a long period of time. Like at the moment, we're in an interest rate cut period, which is generally, continuing on. I think New Zealand just today did 6 cuts in a row. So this is the kind of thing that often does spike these trends. Now, if we go to a weekly, it looks very different. All of a sudden, we start to put together different information. One of the pieces of information that Tyron and I often talk about is the 20 weekly moving average. You'll notice here that on the way up through this trend, it seems to like coming back to that level. So that could be a point that we want to mark out for our smaller time frame trades in the future, should we ever hit the weekly 20 again. Another thing that's happened is that we're clearly in some form of consolidation range. And for the first time ever, we saw a weekly close last week at an all-time high. So that doesn't mean that it was an all-time high in terms of price. It was an all-time high in terms of weekly close. And sometimes this can suggest that funds or money managers or whoever is actually trading this market, they've been convinced enough to actually close the price at those levels. And as we often say, the close is the key. So much information garnered just from looking at the monthly, just from looking at the weekly about the trend. And I think overwhelmingly, Ty, we can probably say that the general flow through the higher timeframes is up, can't we?
Yeah, absolutely. Yeah, most definitely. And I think it's very clear when you look at, and I think that's the advantage of looking at the bigger timeframes, that the picture is painted very quickly. Like it's not a real lot of guesswork there. And gold's an exceptional example because obviously it's seen one of the biggest runs in modern history. We can see here. Yeah, I think anybody can come off the street and see that we can in a very strong uptrend on the weekly with no technical experience whatsoever. So, but that's what we're looking for. It doesn't mean that the trade is weakened anymore by that. It's actually understanding that it's a very clear picture of where you want to be in the process. Do you want to be buying or do you want to be selling? I look at that on the weekly and say, yes, we're seeing some consolidation over the last month and a half, but up until that zone, and even now, I wouldn't want to be shorting this beast. We're getting no indication that you want to be doing that at this stage. And I think, that bias alone is worth the multi-time frame analysis, because straight away there's only one direction we're looking for, isn't there, Tom?
Yeah, well, that's right. So now we've have probably, which is going to be the stronger side to be on, which is the buy side. And this is where things become very important as well, because let's say it comes back down to a level. What if it comes back down to this demand level down here. Well, this could be a strong level to be in the future looking towards buys. Obviously, if that had happened, we would have been looking at that. Now, if we go to the daily, this is where things become a little bit more clear of what we're actually looking at. And you can see here that things are a little bit more murky. So we've got our weekly flow, we've got our monthly flow, we've kind of made those decisions. We can clearly see there was a support that was broken, which was 3,200 just recently. And that at least on the smaller timeframes, that may have looked like trend was changing towards, pushing down towards this 3,000 level. And of course, on the smaller timeframes, that might be what you're looking at. But we have to remember that on the higher timeframes, the weekly and the monthly, the flows were still bullish. And this becomes very important when you're looking at these technicals, because that means that if the bearish position, which was on just a few weeks ago, then reverts back to being bullish, it could have trapped a lot of people into the wrong movement, because we know that generally speaking, this market is more bullish than bearish. We know that flows on the higher time frame are most likely going more bullish than bearish. So that means that if a short then turns into a long, that people could be caught off guard. Has anyone ever in the chat right now been caught offside? That is on the wrong side of a trend because you thought something was going to happen, it reverses on you, and then it goes off in that opposite direction. And you're probably left scratching your head saying, what just happened? A lot of that comes back to understanding these higher timeframes. So you can see here the daily, once it closed back above 3,250, it really changed everything, didn't it, Ty? It went from a series of lower lows and lower highs and lower lows and lower highs and lower lows to suddenly breaking to a higher high, and therefore, at least on the daily time frame, changing trend. And when that happened, it became better for us as traders and scalpers and swing traders or any of those things to look more towards the bullish side, didn't it? And that's kind
Absolutely.
of the bias that I think I would have on this chart right now based on the multi-timeframe analysis.
Absolutely. And I think probably the other thing you want to be looking at now, and I think it's really important because obviously we're seeing the patterns form basically on a weekly basis. We can see, we talk about them every week. Gold's always one of the staples that we look at every week. That there is a potential that if it does break to a new high here and we see, a close above, say 30, I call it 33.70, we're looking at going to that 34.50 to 3,500 again, because really we can see we've got a very solid level of higher high and higher lows. But on the flip side, there's also that danger that, and the daily is actually showing it just as much as the 4 hour does, that if it doesn't actually make that high and actually turns around and starts pushing down past that 31.80, that actually spells quite a significant shift in movement. We can see, Tom can draw it as I think about it, the head and shoulders on the 4 hour, which could be potentially indicating that. Now, there are two things to be very, very wary of. That yes, we have seen a very, very big rise in gold, but like that weekly chart showed us, we're in a consolidation period right now where it could easily swing either side without any surprise. I don't think anybody would be surprised to see gold back at $3,000, or I don't think anyone would be surprised to see it at 3,600. I think it could go either way without surprising anybody. But there is a setup for both scenarios, and realistically, we can see here that that head and shoulders plays all the way down to 3,200, and if it gets down to that 3,200, it starts to put pressure on the support level, and if it doesn't hold there, potentially 3,000 will be the next level for it. So. And I think that if it gets to that 3,200-ish area now, which we'll see that pattern basically fulfill its destiny, if you like, I think that test of that support may not be as strong this time. I think that because that'll be three. If we go to a daily for just one moment, I'll show you what I mean by that. If we go to a daily on the gold, you'll see that if we do see a failure point here and that lower high, lower low kicks in, that'll be the you'll basically see that weakening of the trough, and that will form a break. And if that breaks down, that's going to be the third swing down on the daily chart, which is actually significant. 3 lower high and lower low points on the gold chart on a daily is definitely a change of trend. There's no question about that. So it's a very, very important juncture for gold right now, and certainly one to watch. Very important level.
Yeah, so at the moment, of course, this is a possibility of the declined market. The current trend obviously is still a series of higher highs and higher lows. So where do we look towards closures being more bullish? Well, we saw before the daily was doing that, but just remember, if it gets above, it's already breaking back into the sequence of the current flow. And I always say, like, if you've got your weekly monthlies in that direction of trend, and then you're seeing the breaks in that direction of trend, they're generally a little bit stronger. So the short could be on. I mean, there's no doubt this could turn into a head and shoulders here on the 4 hour, something to keep an eye on. We obviously keep open to the abundance mindset of different opportunities in markets. But at the same time, if we break to the upside, that's a great movement for the weekly and monthly flow. And that usually is the stronger trade. Because remember, going in the direction of the flow, knowing that weekly, monthly is more bullish than bearish at this stage and has been for a long time, every time you've seen a bullish setup, it's worked better than the bearish setup. The stats wouldn't lie. Yep. That's exactly how the bullish setups have been more strong than the bearish setups, and they've gone for longer periods. And that could change, as Tyron said, with the sequences. But at this stage, this is the way you kind of want to be looking at it. And you Absolutely. Want to be aware of both sides.
And I think probably the important thing to take out of that as well is the open-mindedness that Tom's talking about there. We have to be very open-minded and not too stubborn on a direction, and actually be able to. The benefit we have as retail traders is that we can change our mind on a dime. We can flip our position and change our direction in an instant. And a lot of big, whale traders or institutional traders don't have that luxury. So we need to use that luxury as an advantage. And I think that being open-minded and being able to actually see what the market is telling us rather than what we want the market to do is an extraordinarily important part of trading. There's no question about that. It's an advantage that we've got, and it's one we certainly have to take advantage of.
Absolutely, it is. So if we have a look here at silver, we go to a different counterpart. It looks very different when we go multi-time frame analysis. Monthly, obviously, it's slowly climbing up there, still making a series of higher highs and higher lows. So again, the flow would be, I believe, on the upside. You can see here as well that we have very, very strong wick rejection on the last monthly, which I think is always worthwhile noting. We go to the weekly here, you'll again see, a large series of sells with rallies, with sells, with rallies, but constantly putting pressure on this upward side. So again, generally speaking, the flow's moving on the upside. And more recently, you can see here, last week, a closure above any of the previous points, which suggests that the markets may want to push that 34 kind of barrier. And then as we go down to the daily as well, you can see that markets have held above these breach outs. They've hit this resistance, and they're kind of coiling in between. And whenever we're looking at a coil, you're always asking yourself, is it dull? Is it generally speaking going more towards the direction of the larger time frame flows? And if I was arguing here, I think I'd say weekly is flow, medium up. You would say the monthly is up, medium again. And the daily here at the moment is constantly wick rejecting with a stronger wick each time, which suggests on smaller time frames, Ty, that this is actually trying to pressure this upside break. So again, if it coils and if it does break out, that could be an explosive move. And as day traders and scalpers and anything like that, this is helpful because we know that based on our higher time frame analysis, if this level breaks, the next stop is potentially 34 to 34.50, which could help us to go, a decent amount of range from a trade if we do see the breakout.
Absolutely. And I think that's really important to note that, and I think probably the other thing I think people probably understand what we're trying to say here, but multi-time frame analysis isn't just on metals or currencies or indices. It's on everything. No, it goes for the stock market in general. Anything that you can trade, requires multi-time frame analysis breakdown to trade it properly. So it doesn't matter what the instrument is, just be mindful of that. We're picking out some of the examples today based on what people always ask for and what we talk about each week. But, make no mistake, whatever you trade, it could be the Commonwealth Bank or it could be the Euro USD or anything that you trade, multi-time frame analysis works the exact same way because what we're trying to do is break down the sequences of what's actually happening in the bigger picture down to a time frame that you're prepared to trade on and really cut out a lot of the external noise, if you like, that could add confusion if you don't know what the bigger time frames are doing or care, because some people don't care, and you should always care.
Well, let's have a look at one of those, which I guess it would be the euro in this case. Very obviously heavily traded pair. We're here on the monthly. I think that if you looked at the last 3 months of data, you would see that the general flow is bullish. So again, very quick check. You come in, you have a look. Okay, a little bit of a resistance here, about 1.14. Next level could be about 1.18. So, of course, if it breaks 1.14 and closes on significant timeframes, that's opening up 1.18 in terms of general flow. We come over to the weekly, slightly different story, but generally speaking, still within the boundaries of probably being bullish. You can see here it's rejected a little bit after a beautiful run, and it's come down, and it seems to have recently found possibly a bit of what we call role reversal, which is a resistance that's then become a support, and a doji candle here, which is a high, low, open, close at the same price, which basically means that the market was at a level of equilibrium, a level of fair values. That's what all of these high timeframes tell us. Go down to the daily then. What are we given? Well, we can see here that we've come down. We've been clearly in a lower high, lower low scenario. And then the market pressured up and it tried to hit and break through this resistance, this supply level, and failed to do so once, twice, doji equilibrium, so they're clearly confused market, and then suddenly went bullish. When that happened on this daily time frame, all of a sudden you went, wait a second, so what have we got here? We've got monthly, up, weekly, neutral, daily, suddenly breaking up. Monthly flow is up, probably a stronger trade because it's in the direction of the bigger money. So always think of it. If you get something out of today, always think higher time frame, bigger money. What should we be doing, Ty, most of the time whenever we're trading? Doesn't matter what time frame. Would we be better off generally being biased towards the larger money?
Absolutely.
And what are most people not doing?
They're going the other way.
Yeah. Most people are biased towards the smaller time frame analysis, and they are not biased towards the bigger money flow. It's not that difficult. You could almost put it on a mug. Should you follow the bigger money? The answer is generally yes, and that is your aim. Realistically, as a trader and investor, you should be following the big flows. So why don't we check the higher time frame? Why don't we consider where the bigger flows are? And remember, guys, it's the close is the key. So whenever you're looking at the higher time frames, ask yourself, has that market closed above or below supports resistances? You know, Ty and I don't talk about this that often, but we have, of course, our day trading masterclass, and it's specifically that really hones in on this concept because it is a repeatable process based on flow, based on understanding that higher time frame money is really key. So you can see here we've got this resistance. We've got this clear wick rejection. We've got a beautiful storyline in markets on the daily. Let's have a look at the smaller time frames. Let's 4 hour here for a second. And it's the same sequence. Lower lows, lower highs, lower lows, rejects the resistance, makes sense, currently in a downward trend. Keeps going down, rallies, rejects the exact same zone. Why does it keep coming up here? That's one time, two times, and it breaches it. And then it comes back down to that same level. Could this be a good level for a scalp for a day trade? Yes, it could be, and it probably is, because what's happened is the sequence of being short on this time frame has gone back to being in that monthly flow to the upside. So then since then, you've obviously got, at the moment anyway, a series of higher highs and higher lows. So it's obviously things are easier in hindsight, but as we've talked about, this is kind of what we've been looking at here on the dollar as well, the US dollar. So some interesting stuff there, isn't it, Ty?
Oh, most definitely. And I think that the more that you understand that, the easier it is to actually read. Like you'll see it unfold very, very quickly when you actually understand and know what you're looking for. I think that makes a big difference. It's very important. Like I said, I mean, we talk about it. Subtly, we talk about it every single week, Tom. I mean, I know we're focusing on it today and really trying to highlight how important it is. But you'll notice if you do watch a lot of our webinars, which I know a lot of you do because you're avid followers and we really appreciate that support. You'll notice that we do this all the time. Like it's very rare that we go to one time frame and just analyze that. We're always starting at the bigger time frames, and whether it's a daily to 4 hour to 15 minute or a weekly to daily to 4 hour, we generally look at least 3 time frames. And another one of our courses, which is the Ultimate Trading Masterclass, it's got the Presic trade planning system is built predominantly on multi-time frame analysis as part of its biggest score attribute. So without multi-time frame analysis as part of the trade that you're looking at, you're not even going to get a score big enough to trade. That's how important it is in our course, that it won't even give you a viable trade if you haven't got multi-time frame analysis in your favor. So that's how important it is. So, and I think more importantly, it's really, really easy. And it's free. It's not like you're paying for data, or you're paying for something that as an extra service. It's actually free to do, and it's very, very easy. So I think if you don't do it already, definitely start looking at least 2 time frames on either side of the one that you're thinking about trading. I think is important. But if you do it already, maybe just apply a little bit more, I guess, finesse. Let's call it finesse. To actually how you understand the flow, because I think understanding the bigger money flow, like Tom said earlier, gives you a massive advantage in the smaller time frames when you're actually trading where the big money is. I can't begin to tell you how big an advantage it is.
Yeah, and it's all about also thinking about, doesn't really matter the time frame. It's more about the structure. Think of it as each one of these, you're seeing the picture of the structure of the market and the way it's forming. So, a lot of people ask us, is your 1 hour the favorite chart, or 2 hour, or 4 hour, or 6 hour, or 8 hour? It's not really about the hour. It's also about the understanding of the storyline inside these markets. So we obviously saw the euro, we saw silver, we see gold. What about the US market? So obviously these have been, really, I would say a little bit moved, probably a little bit more than a little bit moved from tariffs, but have they been fairly technical? Well, yes and no. I think that the market probably always has a reason and always has a valid reason. So if you want to say, like, why did the market why did the market bounce last week? You could argue it was the daily 20. So if you're doing the higher time frame analysis, you could have said, okay, well, we got one bounce off the 20, respected it on the way down, bounced off the 20, bounced off the 20, and now we find ourselves here. You could also say, if you put a 200 daily moving average on it, that would have been bouncing off around the same zone. So a lot of, there's always a reason. Now, that being said, if we go and look at the structure here, we can see that the general gist of the last kind of 2 months or month and a half has been now bullish. We have a series of what was lower lows and lower highs that then was broken through the last couple of sessions, which kind of details that, generally speaking, the market bulls are back in control, doesn't it, Ty? I mean, what are your feelings on this? Do you think the market bulls are in control right now, or too close to call?
I think the market bulls have been in charge for quite some time, actually, and I think that the market is looking for that feel good story, and if it is looking a little bit weak, there's nothing like a tweet or a press conference to fix that, and the bulls come roaring back. But I do think, though, that although the bulls are in control of this market, I think that we would still want to be careful, because I think we're approaching a very precarious level. This pullback was good. It was, it was deep enough, I guess, that you could say from a technical standpoint. But yeah, we talked about it, I think it was last week or maybe the week before, that the market has gone up faster than it came down, which is very unusual. It's a very unusual V reversal.
They call it V shape.
A V-shaped reversal. So, yeah, when we're looking at that, it always pays to be a lot more cautious, that we're only, one news story away from a significant pullback. The rises, I think, are going to slow down a little bit now on the way up. I think we've already seen the euphoria kick in terms of what has been proposed, but I think that there's a lot more to play out. Time frames, 90-day reliefs starting to, come close to an end. It won't take very much to. I think the market's still unstable, is probably what I'm trying to say. Actually, I think it's still a time to trade very, very cautiously. It's not a time to say, okay, I think everything is good with the world. Let's go long and not worry about it. I think it's fast approaching, the S&P 500 in particular, is fast approaching a very important level around the 5950 to 6000. I think there's a lot of resistance there, and it has slowed up somewhat. We've seen a day today, like the last couple of days have been strong enough, but where we've got it circled right there is significant heavy resistance at that point. And I think that needs to be respected. So it's a good time to scalp. right now. It's still not, I don't think in my mind is the time to go for long-term positions and just sit and wait. I think you need to trade. And it's good because we're traders. And that's why we do these webinars every week. We're looking for action every single week. So I think it suits us. But I think we just need to be aware that there are some significant levels ahead. And even though it does look a little bit strong, there are significant headwinds that could pull it up. And because it's come up so quickly, the pullbacks might be a little bit more violent than you could otherwise expect. So just be a little bit careful.
Yeah, and just remember there'll always be a valid reason if you're scalping a daily or a multi-day or anything like that. Then it doesn't really need to be as you just don't need to be as worried about the news. You just focused on the flow and the movement. Price action, price action, price action. You saw before 6,000 is the most traded zone of the previous range, so obviously it makes sense that the conjecture point for that. Another thing that I'd want to mention is whenever you're doing your multi-time frame analysis, a good rule of thumb is to look at the S&P, that is the real market open, and not just the futures, which is the CFD platform, of course, we're using here with Pepperstone. And the reason you want to do that is because what you're given here are the gaps. So effectively, the differences between the closes and the opens, and then the opens and the closes, etc., on the other way around. And what you're noticing here is you've got a 5,800 gap, you've got a 5670 gap, or 5070-ish. You've got gaps that are left from back here from a while ago. And there's quite a lot of gaps in this market. And that suggests, to Ty's point, this market has been news driven. Because the only way that you really get this many gaps is news. And that is a difference between the close price of the previous day and the new open price the next day. Something's happened overnight. And this is where really Trump's tariff tweets have come into play here on the S&P. So I think you got to be aware if you're trading the S&P, NASDAQ, Russell 2000, any of those levels, that you are facing a lot of futures market risk, because a lot of these trades or a lot of these big movements have been happening in the outside. Also, gaps can give you areas to look for day trades and look for areas to take profit and all of those types of things. So something to note. Now I'm going to bring up the Russell 2000 because I think this is probably the most interesting from a multi-month, multi-time frame kind of action. We'll just delete whatever's going on here. And what I'll show you is the way that we would approach this. So first up, we come and have a look at the monthly. You can see that recently the price went down all the way to those 2022 lows. So actually it came into these major support lines and found obviously some buying pressure off that. We go to the weekly, you can clearly see now that there's a resistance that's being formed, and it seems to be consolidating around this resistance, and that if it does break out, it's likely going back up to this 2,300 Z level. And this is again the multi-time frame analysis. We go to the daily then, what we can see here is that we have a market that is pressuring this resistance, has been unable to break through, but what if it does? And this is where I think the high time frame analysis down to the lower time frame analysis becomes really interesting, because of course you can make cases then for head and shoulders pattern with a right shoulder here and a left shoulder here and a head over here. And you can make a case that this is an incredibly important break zone, which could start a bit of interest in smaller cap companies. And that could have some okay day trades in it as it potentially moves towards that next level of equilibrium. So by doing the analysis, you get a bit of an idea here of, levels to watch, key levels that you broke out, probably some kind of news catalyst that may do that. And then if that happens, where's the next most likely scenario? And that's, again, that essence of the multi-time frame analysis. So Ty, I think that's the type of thing that we really want to get through on this lesson.
Most definitely, and hopefully you've taken some really good notes on it, because it gives you a really big clue as to where the next move might be. And I think that when you understand that and understand where the prevailing trends are, I think you can trade with a lot more confidence as well. And confidence is a big thing with trading. When you can get your confidence in line with your expectations and where the general market movement's going to be, it's going to elevate your trading skill and success for that matter, because they go hand in hand. So yeah, hopefully you've been able to take some good notes from that, because we do talk about it every week. It's not like this is not like a new topic. We talk about it every week. But now when we do bring it up in the coming webinars, you'll have a bit more of an understanding as to why we're doing it. I think that's really important.
All right, guys. Well, look, firstly, thank you so much for coming through and obviously, check stuff out. Stuart says, good session, guys. These really helped me consolidate my understanding. Craig, thank you very much for getting involved in the chat. And many others out there, thank you guys for coming along, Silvio, etc. It's always great to see you guys here, so appreciate that. But to get out today, remember, the largest timeframes hold the most amount of money. So why are we not paying enough attention to those?
The time frame pattern,
bigger time frame patterns hold the most amount of money. So, and that just makes sense because, of course, bigger decisions are made over longer periods of time. So consider that next time you're looking at your charts, monthly, weekly, daily, 4 hour, 2 hour, down to 15 minutes. You can do it in a couple of minutes. You don't have to keep checking the monthlies because they only close once a month. So maybe start to bring this into your trading and investing systems and start thinking about markets as a storyline. And hopefully that helps. Thank you from everyone here at Pepperstone. And remember, click on the links in the description down below if you want to join us here live every Wednesday for these sessions. Now, quick announcement. I believe next Wednesday we will be not doing this session. So it'll be 2 weeks from now. So it's usually every Wednesday, but we do have a live session that we must be doing. So we've got
a live event next week, everybody. So fly in from London and America, and it'll be well.
Yeah, I'm sure they'll be doing that.
You'll love it. But if you are actually in the Sydney area and you would like to join us live, we are going to be live next Wednesday in Sydney. So if you haven't already registered and you can make it to the Sydney CBD, I think it's a 6 o'clock start or a 6 p.m. start, 6:30 start. We'd love to have you. It's free to attend. All you've got to do is just click on the link. So you reach out to Pepperstone or ourselves if you're not already registered. And there is still room for some people if you want to join us. So we're really looking forward to that. But other than that,
just be warned, it is about to close. We're probably pretty much hit the numbers. So it's probably a few spots left.
Only a couple of spots left. So you definitely want to, if you can attend, we would love to meet you and see you there. So, but other than that, thank you so much for everybody joining us again today. We'll see you in 2 weeks at the same time. And thanks again.
Awesome to hear, Stuart. Thank you so much. Thank you, everybody. Bye for now. We'll see you in 2 weeks' time. Or maybe a week if you're in Australia. Catch you for now. Bye-bye.